and welcome to a new episode of Macro Mondays. We're the officials filling in from James Brodie, filming in the new Flux studio. We hope you enjoy. Today we'll be looking at key market data, charts and risks. So to start with, the S&P500 Gold have been making new all-time highs. But we've seen some pretty hefty revisions to employment data as the labour market continues to soften in the US.
We've also seen some bond market volatility volatility spikes as yields fall, and China's deflation problem worsens even further.
So yeah, we'll start off on the employment side in the US. We've seen the labour market soften pretty considerably actually compared to where we thought the market was even just 2-3 weeks ago. The US jobs report was pretty soft, would you say, Spiros?
Yeah, exactly. It was, as we say, the lowest since COVID. So it's very concerning. And the fact that we see more part-time workers joining than the full-time workers is also a concerning bit.
Yeah, I mean, for me, it was all in the back data, really, the weakness. I mean, 22,000 jobs added last month is soft. Yeah. But June was revised down by 27,000 to minus 13K. That's the first time we've lost jobs in a payrolls print since 2020. So that's screaming soft labour market. I mean, we thought we were in a no hire, no fire jobs market, but it seems we're in a no hire, fire jobs market now. So this is going to be concerning for the Fed, right? Would you say?
Yeah, I think we've seen quite a significant rotation of focus from Powell since Jackson Hole and the Fed rhetoric as a whole, where they've moved much more to concern about this job market. Because as you said, we had been under the impression we were in a pretty solid, stable kind of status quo job market where, as you say, no hire, no fire. So the job additions were still kind of rumbling along. Definitely. But this downward revision, which was in total up to the 12 months to March, was 911,000 jobs were removed.
That was a separate revision.
Yeah.
So we've had the non-farm payrolls revisions, but then we've had a broad baseline revision to the total employment statistics, which was 911,000 jobs that we thought were there that were not there.
Yes.
That's over the past 3 years, it's been more like 2 million jobs. Every year we have a pretty big downward revision. Yeah. Last year is something like
820,000 or so last year, from memory. Yeah.
This year, well above expectations, 911,000. So that's an average of 76,000 jobs per month.
And obviously it gives Trump the ammunition as well to go after the BLS even more. And he fired the former chief and he's put a new one. So you've already got this kind of Trump versus the economic establishment of these bureaus and the Fed as well. And this is just going to worsen that.
I mean, in the kind of in the afterrim of COVID, we were aware that the Fed had kind of pivoted its data toolkit, and as opposed to looking at standard non-farm payrolls, they were looking at a more varied selection of data points. But I do think, if Trump goes down this kind of defunding of the BLS, defunding of the Bureau of Economic Analysis, that will only give the Fed less data points to base their forward view off of. Obviously, they conduct their own regional surveys, so they have a lot of information from there. But for me, it seems like a dangerous path to go down.
I think we're already seeing that with in the data in this August CPI assessment. 36% of that was estimated data. Yeah. And that's up from an average of around 10% from 2019 to 2024. So the quality of the data that these decisions, the key economic decisions, monetary policy, fiscal policy that are being made is on quite weak quality of data.
We've seen that in the markets, that is portrayed in the whiplash we've seen in OIS pricing of interest rate decisions. We've seen that kind of go from, markets only expecting 1, maybe 2 this year to basically almost pricing 3 fully. So it'll be interesting to see how this unfolds.
I think as well we've seen that whiplash in the bond market as well, which comes onto the next chart. Is that the MOVE index has picked up massively in recent weeks. Yeah. Whereas if you compare that to the equity, the S&P volatility index, the VIX, that's remained pretty subdued. So you're seeing more of an impact in the bond market than the equity market. And I think that's partly due to the equity market being a bit more kind of separated from the headlines at this point. They're quite headline fatigued, and I think that's coming across more in equity markets than bond markets.
Yeah, it feels like we're moving now to more activity in the bond market, as you say. We're seeing steep drop starting from I think the start of this year. We're seeing also 10-year or 20-year treasury auctions were pretty bad recently. So you see that picking up slightly. That happened last week, where bid to cover ratios were increasing again. So there's some more appetite for investors to start investing in the bond market.
Yeah, and we've seen kind of investors kind of roll their purchases down the curve. We're seeing much more appetite for kind of the short tenor 2 years than we are for the 10 to 30 years. So I mean, to me, that tells me that there's an element of risk being priced into those 10 to 30 years. Part of that, I imagine, comes down to long-term inflation expectations. If we think that the Fed's going to take a more dovish stance, then and be a little bit more open to having a higher level of inflation, I think there's an inherent default risk being priced in there as well. So yeah, I mean that's captured by this. We also have, I think, with equities in general, because we've had such a big flow of retail investors, they tend to hold on. They tend to not de-risk even as risk becomes elevated. I think that VIX will move pretty heavily if we get a surprise from the Fed this week. But I don't envisage that happening, as I don't think much of the retail market do. So yeah, it makes sense. But yeah, we're seeing a bit more volatility in the bond markets, which is a bit unusual.
Yeah, I think as well, there's a key level that we're looking at now for the 10-year yield, right? Because on a Thursday, I believe it came down to just below 4% and immediately bounced back off. 3996 or something, just below. But it has bounced back up since. So I think that will be a key psychological level as much as anything, because you haven't seen anything as low as that for months and months.
It'll be tough to break that. I mean, I remember when we went down very briefly to like 388 on the 10-year. And that didn't last very long. I think we're going to have a lot of support at those levels. We'll probably see profit taking and people start to sell that.
Agreed.
So moving on, China, we've seen some pretty soft data there. But as is always the case, do you think it's bad news is good news? Are we going to echo?
I mean, so far it looks like it, even though we had CPI 0.4% year on year. I think we also saw the PPI, even though it was negative, it was month on month flat, and the Chinese government gave credit to the fiscal stimulus they had done in certain industries. So we could see some potentially upwards moving trends soon. But it's still unclear, right?
Yeah, I mean, the concerning data for me is fixed asset investment. That was up 0.5%. That's basically flat. If the Chinese economy cannot support investment, then it's going to struggle. It's going to be on life support indefinitely.
Yeah,
and that tells me that all the recent, although retail sales have softened, they had a strong start to the year. That seems it was almost exclusively supported by stimulus. Getting the Chinese economy from this kind of life support mode where all of the activity is generated largely by stimulus into a more organically growing economy is going to be difficult. I mean, if you look at China's top 10 cities, the new home sales dropped 14.7% year on year. And if we think about what the catalyst has been for all of this soft data in China, the sluggish economy over the past 3 years, it's been the housing market. So if we do not see recovery there, especially in the top 10 cities, the big 10 cities, then we're going to struggle to see.
House prices as well, while the sales are coming down like that, prices are coming down as well, 2.5% down again year on year. In August, that came out over the weekend. So I think the foundational problem remains the housing market, as you say.
Yeah, and bond markets are already pricing in some further cuts from the PBOC. I mean, we saw PBOC come out a little bit hawkish earlier in the year. They were holding fire on more cuts. probably because the Fed was on wait and see mode, so they didn't want to move too aggressively beyond that. But now that the Fed is starting to think about cutting again, if we get a September cut and that follows through to further cuts, then that might open the door for the PBOC to be a little bit more aggressive in their monetary easing. And I think the bond market's reacting to that. So we've seen kind of yields move pretty sharply lower on the soft data this morning and over the weekend. And I think that's going to continue. That will increase, that'll help liquidity. I mean, we've seen a little tightness in Chinese liquidity, I think, but that should hopefully help the fixed asset investment. I'd like to see, new yuan loan issuance start to uptick a little bit as well, because outstanding yuan loans descended again, 6.9%?
6.8, I think.
6.8, down from 6.9.
Yeah. But lowest
since like 1998.
Yeah, pretty much, yeah.
So that's pretty concerning. And if I was the CCP or the PBOC, that's what I would be looking at as wanting to stimulate. And I mean, China has mulled over helping local governments issue $1 trillion of bills. I mean so it's another bazooka. It looks like on the high, and that worked fairly well last time, did it?
Well, to some degree, because as you say, it's supported liquidity. It's increased the retail sales aspect of the economy. It's helped to boost these areas of activity and sectors, but it hasn't really translated into an organic, as you said earlier, an organic self-governing economy that's able to support itself without this intervention from the PBOC, from the CCP. So I think the further they go down this path of just throw money at every problem, the more they could hide the underlying problem, but it won't resolve the foundational issue, which I think is lack of consumer confidence due to largely the real estate crash from a few years ago.
Yeah, definitely. But I mean, the soft data didn't stop a kind of housing market or the credit market. Industrial production and retail sales both underperformed expectations. And as we discussed, fixed asset investment was bad, but unemployment ticked up to 5.3%. So I mean, where do you see this going? I think.
I think we need to see a bit more recovery on the industrial side. I mean, the overcapacity issue in China remains very problematic.
It's systemic.
It's when you've built so much capacity and then the demand begins to slow, suddenly you end up with this massive surplus of effectively supply over the demand that's lacking in growth. It undercuts your margin as a business, and then it puts more pressure on your lowering costs, which can then drive the deflation problem.
Exactly.
And put pressure on the business, maybe cause some bankruptcies. Here you can see an effect on employment. So employment's going down, unemployment is rising. It was expected to stay steady at 5.2%, but it's come up to 5.3%. So that's a bit of a concerning indicator. So I think if we don't see, an improvement on that side, then it will be quite concerning. I don't really see a particularly easy way out of this. I don't know if either of you has an opinion on that.
I mean, at this point, the only case is to export, right, to other countries. And China used to export a lot to the US, but we saw last week that the exports to the US plants, they were down over 30% year on year. So it's concerning a bit now with geopolitical concerns that are developing with the US and China. Where are they gonna sell? Are they gonna sell to Europe? But they probably will sell at cheaper prices than they would sell to the US, right?
Yeah.
So they need to get market share somewhere else.
Yeah, I think with China it's a little bit difficult to unpack because you never know what the CCP are thinking, and they're very strategic in how they conduct their policy. So we've seen a lot of targeted stimulus at home appliances, at EVs, and they've been trying to diversify their export portfolio for EVs and for areas that they want to have comparative advantage, and they've done that pretty well, to be honest. They have pretty much a global comparative advantage in most technology, I would say. EVs, batteries, they have the full supply chain. They're starting to develop their own new chips. Their AI models are starting to to only grow, and they're seeing more investment there. And some of them are even outperforming the Western counterparts that have been industry leaders for quite some time, really. So I think we're also seeing a bit of a transition in the Chinese economy from, what was a kind of a raw materials primary sector economy into a more secondary sector, finished goods, technologically advanced economy as well. And that sort of process obviously takes a lot of time. You need to upskill labor, and perhaps that is what we're seeing. Perhaps we're seeing a kind of a transition.
Yeah, I think the main threat to that, because as we've said, domestic demand is pretty weak.
Yeah.
They need to find these new export destinations. Part of the problem with that is obviously the protectionist policies that these potential clients and customers in foreign countries are putting up. So Mexico, for example, has just hit Asian EVs, not only Chinese, but also South Korean, Japanese, with 50% tariffs on their NEV exports to Mexico. Europe still is imposing the quite strict tariffs on Chinese imports. So although they have a comparative advantage in terms of production cost and perhaps quality, they do have to overcome this additional hurdle of the policy in place in these export markets.
Yeah, it's true. But those tariffs in Europe have nothing new.
No, it's more the Mexican and the other countries that are bringing in the new policies.
I take your point, but Chinese EV sales into Europe are only increasing.
Yeah, that's true.
So they're still, even with these protectionist policies, with the red tape, they're still able to remain competitive, with the thanks of the CCP.
Yeah. But we also have additional concerns, right? So we saw that, as announced by China, the hidden local government debt was over $1 trillion, which is about 10.5 trillion won. So it's concerning, and the base year we just have to fresh liquidity into the banking system. They announced that will inject about 500 billion won, and they said that this will unlock over 6 trillion of lending in the banking system to the local government. So let's see if that's...
Yeah, I think, the hidden debt has been kind of like a recurring story with China. Everyone's been very concerned about this hidden debt for at least the past 3 years. I remember discussing it on one of the very early officials podcasts over a year ago at this point. What the CCP are doing, and what the PBOC will probably assist with, is they are just replacing that hidden debt with their own issued debt. So the government are slowly rolling that hidden debt, that bad debt, off local government balance sheets. And this is helping the situation, and I think markets are reacting. We've seen credit rating agencies be quite lenient towards China, really, when in other scenarios, had they had a similar debt burden like this, that they might not have been.
Yeah. Well, I think the example of that is France, which brings us on to the next point, right? Because they've just had their credit rating lowered to the lowest ever by Fitch. And the France debt story is a concerning one, as like the 10-year OAT has risen to over 3.5%. So while the government implodes, they've also got the debt problem to tackle, but they can't tackle the debt problem because there's no government. And when there is a government, it's deadlocked into a kind of a hung parliament situation, which means that effectively they're in a catch-22, because whatever the new prime minister does is met with protests. He's met with disagreements in parliament that mean it's impossible to get any actual progress through the body. So really, France is in kind of a downward spiral at this point, and it's driven by the debt and the political
uncertainty.
The schism.
Yeah, I think you're completely right. I think there's been a lack of fiscal responsibility throughout Western economies, but particularly in France, they don't have the growth to back up the borrowing. As an economy, if you want to borrow, you have to grow. Yeah. Otherwise, you're not going to be able to repay it. Yeah. Or you just have lots of inflation. France have none of that, so they just have the borrowing. So it's no surprise really that we're seeing ratings downgrades. I think this will be the first of a few. I wouldn't be surprised if this continues. US could be, if they struggle to grow their way out of this, we've got a lot of very fiscally expansionary policy coming through, tax cuts. Tariffs have largely failed to fund the deficit as Trump had promised. So I think ratings agencies will be looking at a lot of Western countries and considering downgrades. And that's spilled over to the OAT market, hasn't it?
Yeah, definitely. I mean, you see now, I think as Goldman Sachs flagged, the European companies' bond yields are lower than the French bond yields. So we're in a situation right now, like the emerging economies, where you usually see that companies have a lower borrowing rate than the governments, and that shouldn't be the case for countries like France. So yeah, it's really. I
mean, you make a valid point. I mean, it wasn't too long ago that we were watching the IMF storm into Greece, was it?
Yeah.
And have to kind of completely revamp the whole fiscal model.
Yeah.
Maybe that's having an effect now, finally, and we're seeing a bit more fiscal consolidation, and equity markets are doing well in Greece.
They were 60% up year to date, so doing really good.
But over in India, we've seen WPI bounce back.
Well, marginally. I mean, if you look at the chart here, the downtrend is pretty evident from around 7%, even just a year and a half ago or 2 years ago. We're now down to 2%, barely. I mean, it's bounced up from 1.61% in July, but that kind of the PPI equivalent for India has really been tumbling this year. And this is all while, and we've mentioned it in previous podcasts, the RBI's rate is still far too restrictive. I think it's 4.5%, 5.5%.
It's 5.5.
Yeah. So, they need to adjust the policy because the market and the inflation outlook is telling them that it's too restrictive.
I mean, they're only 150 bips from their cycle peak.
Yep.
So they're really still in a kind of a restrictive mode. And with inflation falling like this, I struggle to see why they wouldn't cut more aggressively. We saw them accelerate, to be fair. So we saw 150 bips cut, and then we saw a 100 bips cut, I'm pretty sure, if my memory serves. So if they continue on that trajectory, then they might be able to resurrect it. But typically when deflation gains momentum, that's something you want to put a pin in pretty quickly.
Yeah.
Otherwise, you might end up where China are now, struggling to kind of get out of that hole.
Well, India is also under the tariff threat as well. I mean, the US has imposed its tariffs on India, and then there's this prospect of potentially secondary tariffs for buying Russian oil imposed by NATO if Trump gets his way there. So, like with China, again, they've got to find an alternative export market, and where it will go is pretty difficult to see, because if you're competing with China for the European market, that's going to be a pretty tough nut to crack.
Yes.
And then, what is the alternative for India for its exports?
Yeah, I mean, they've been looking to Russia. So they've struck some trade deals with Russia, doubling their bilateral trade is the goal. But you're completely right. What India does have on its side is a rapidly growing population, which not many economies can say they do these days. And that will help. Just purely population growth will help keep that engine going, keep demand growing. Yeah. And that's going to be, but you're completely right. The tariff threats to India are more severe. Trump seems happy to place 50% tariffs on India. He knows he can't do that with China, so he's going extra hard on India. Moving on to oil. So what have you guys been seeing in the oil market recently? We've had some pretty big allocations, Saudi allocations to China. We had a pretty mega drop in OSPs.
Yeah. So basically, recently, last week or two, it's been a kind of market share story, right? Are the Saudis going to go and fight to try and regain market share, increase output, sell more to China? And that's, in a way, produced a market that's quite kind of nervous. You can see on the chart here, there have been a few moments where you've had some really skittish jumps and drops.
It's been a lot. a lot of headlines as well.
Yeah,
right?
that's
CTAs on headlines.
Yeah.
I think.
Yeah, and I think that's partly because of, like you mentioned, the OSPs, the official selling prices, which give a kind of indication of the Saudi direction that they're going to follow, and then the larger allocations to China than we saw last month. So you're seeing this kind of narrative of the Saudis are producing more, but then as we've been reporting on quite forcefully, that's being absorbed by China for now, and they do have capacity to keep buying it.
Yes.
But it has produced a market that is quite nervous, quite jumpy.
Because I mean, China are basically supporting the curve at this point, right? Like they're the ones soaking up this huge surplus that everyone's got in their balances. You know, we've heard even some of the big NOCs that are saying their balances are pretty long. You know, our own balance, we have about 1.5 million implied builds this million a day, and the curve's still backwardated, and a lot of that is to do with oil flowing to China. I mean, we saw allocations last month; they came off a little bit. So seeing them bounce back this month, I think, is probably you know.
Well, you say they came off. They came off from a record high for a few years, and then they bounced back exactly to that record high again as the official selling price has gone up and then back down again. So effectively, it's flipped in contrast to the pricing. So really, that's kind of I think that's for commercial reasons as much as anything.
But then again, we saw that physical premiums had implied a cut of around 50 cents. I think that's what we were looking at to the benchmark Arab Light into Asia. Instead, we got a cut of $1. So that to me is like Saudi are like, we need to place these barrels. So do you think that's kind of, China were taking their foot off, and to entice them back to buy those barrels, Saudi needed to create more room for the...
I think exactly that. I mean, we heard from a Saudi source verbatim, we need more sales. Right. So as soon as the Saudis, the biggest producer, biggest exporter, is saying that they need to sell more, that's going to give the market an indication that, you know, there's going to be more on the market. And the question is where it goes. And for now, it looks like China's happy to gobble it up.
Okay, so in a week's time, Brent flat price, where do we think? Up, down?
I think slightly up, maybe
slightly up.
Upper 60s, I think is quite a comfortable place.
Yeah, I think it's fair enough to say upper 60s. I don't see anything below 66.50 as we saw also last week, because China will definitely ramp up the purchases. As we flagged, they probably will increase the purchases by 200 KBD to 700 KBD. So that's a big increase. And it feels like if it just goes below, they'll just keep increasing the purchases, right?
Definitely. I mean, historically, they're flat price buyers. Below 70 is fair game. So I think you're right. I think kind of 65, 66 probably a floor. And I think we have a little bit of room to go higher. But I think we'll also be, we won't be.
I think we'll struggle to get to 70 or higher. I think that will be a challenge.
And then in elsewhere in commodities, we've seen gold making a new all-time high. How's that come about?
Well, I mean, we were talking a week or two ago about it looks ready to go higher. And we were talking also about silver versus gold, which one is going to lead the charge. And, you know, gold, like last week, it has just surged to a new all-time high as well, 3,650 per ounce. And, you know, in terms of an inflation hedge, that tells you what the market's thinking as well. It's expecting Fed cuts, maybe more inflation. So gold is kind of the natural destination for that defensive strategy.
Yeah, I think it's also the geopolitical concern right now, because we say that, you know, it's gone above the usual inflation yearly rate. So you see central banks are wrapping up their purchases of gold. The euro share has now fallen to the third best share from central banks. And then everybody's just shifting to gold investors, because when there's volatility and uncertainty, you have to move to those commodities.
I mean, don't forget as well, from a technical perspective, we have just broken a key resistance level there. So, you know, as we discussed last episode, any move beyond that key resistance will probably be quite aggressive, and that's what we've seen. So, we've seen that. I mean, where was that key resistance? Kind of like
3,500-ish.
Yeah, just below 3,500. So, yeah, that's a pretty fat candle over there. So, we've had a big aggressive move in gold. Gold was our favorite over silver. I think there's a few reasons for that, but I think it's good inflation hedge. I also think it's spec. I mean, people are buying the narrative on gold.
You buy the gold standard, right?
Yeah, and I mean that's the evidence is here. I mean, gold has eclipsed its inflation-adjusted peak. It was last set 45 years ago. So that's a pretty big move. And if you just look at the ratios, I mean, so we had a bit of a blowout in the gold-silver ratio back in
April, just after the Liberation Day tariff announcement.
Exactly. So back in April we were talking about perhaps good time to get in silver, but that gold-silver ratio is kind of descended more to a neutral stance now. So here, gold, silver, what would you be buying still?
I think that overall it depends on your reason for buying. So if you're looking for an inflation hedge, then you go for gold, because that's where everyone puts their money in, the inflation hedge, basically. But if you want to look at the technicals, I think silver is still quite attractive. So I would still go to gold, personally.
Yeah, I mean, if we look at the ratio, it's kind of bang on the median there of the histogram, as we can see on the bottom right of that chart. So it's a bit hard to pick one over the other, really, from a ratios perspective. I mean, I'd probably buy, as we said a couple of weeks ago, a basket of a few. But I think, gold is still probably my preferred. What about you, Spiros?
Yeah, I think gold is the one that makes the headlines always. Silver is always the one that, by the looks of it, moves slightly slower. It's when people want to basically trade the spread and benefit from when silver is priced under gold on a relative basis.
Yeah. And copper, we've seen a bit of a breakout there as well. Do you want to talk through what's been going on?
Yeah, well, copper's been an interesting one lately, because you've had obviously the Trump tariff threats that have caused a spike and then a drop quickly in US copper. But I think LME copper has been kind of gradually grinding higher, and then recently it has jumped in the last week or so. And you could take that as a kind of overall good sign for the global economy, but I think it's also just part of the overall metals rally. Part of the kind of search for diversification as well. If people are beginning to think that the equity market is looking over heavy, bonds don't look as safe and stable as they used to. So I think it is also partly a diversification play as well.
Yeah, and I think copper is kind of, historically has been that kind of bellwether of the economy. When the economy is doing well, copper's doing well. I think it's becoming less and less like that in a comparable way to the US equity market, which is kind of, ratios are blown out and everyone's kind of jumping on the AI bandwagon. I think copper has been subject to that as well. I think, AI has provided a lot of support for that, and if we don't see the uptake that we're expecting, then it could be quite concerning for the copper investor. But yeah, it's a good technical breakout we've seen there. Where do you see it going from here?
I think we can see a bit of consolidation at this point. Maybe a moment to kind of review, think about kind of the outlook as well. If we do put as much faith in that, as you say, that AI demand driver, or if we see that weaken again. And I think that will be kind of indicated primarily in the equity market, because that's what's really driving that first. So that could give you a good preliminary indication of what's going to happen with copper.
Yeah, definitely. And as we alluded to, S&P has been on a bit of a tear as well. We've seen S&P500 close at a new all-time high, which puts it up 36% since the April 2025 bottom. So that's $15 trillion in market cap added in just 5 months. I mean, this is pretty
insane.
Insane, yeah.
And I mean,
we're not talking about any recovery here. We put the chart over there. It's the great financial crisis, COVID crisis, and these were times of recovery. Right now, we're supposed to be in uncertain times, but economies are still expanding. So if you're comparing this, there's something concerning. And you see this, the tech stocks now reflect over 37%, which is even higher than the dot-com bubble.
Yeah. But then, I mean, we are entering an easing cycle and do not appear to be in a recession. So when the central bank is cutting rates and you're not in a recession, having equities fall is pretty much unheard of. So I think, like if the Fed come out on Wednesday and they strike a dovish tone as Powell did in Jackson Hole, then I think we're going to see further strength in equities. That'll be key to what the market's looking at, I think, is what is the rhetoric at this week's FOMC. I would err on the side that he might Powell might feel like he was a little too dovish after Jackson Hole. And he might try and pull back a little bit. Because, if we see the IS pricing 75 or more by year end, I think that's a little bit optimistic. I don't know.
It's currently, I think, as of this morning, 70 pips for year end. So I think it is also on that cusp of 2 or 3 cuts this year. And I think they will need to take advantage of this FOMC to give some kind of indication of the forward guidance.
Definitely.
So in that sense, I think more interesting than the actual rate decision will be the conference and the rhetoric around it.
Yeah, and a lot of FOMC narrative up until this point has been inflation. And it's true, the US has had rising inflation. We've seen broadly core and headline tick up a little bit.
By the way, it's worth noting that PPI, that really hot print, was revised down. So the kind of concerns about cutting into a rising inflation environment are slightly offset, but it is still a bit concerning that the original estimate was that high.
Yes, and I think, I don't think inflation's going away, especially if we do enter an easing cycle. But the warning lights are flashing in the labour market, and I think we saw a pivot at Jackson Hole, and I think the Fed is now going to be squarely focused on resurrecting the US labour market before it's too late. But elsewhere in equities, we've seen Oracle jump 36% in a day.
Yeah, I mean, if you want to look anywhere for the AI or the hopes being pinned on AI, look at Oracle. I mean, their actual revenue wasn't particularly impressive, but the forecast was something like near to 500 billion in forecast AI demand. So that's caused that 36% jump. It made Larry Ellison the richest man in the world, because I think he still owns something like 40% of the company. So purely based on this, he's gained like a third of his wealth in a week, which is pretty phenomenal to think about.
I wonder how many stock options are exercised on that.
Probably a fair few, but you've seen already on the chart, you can see that it's already started to come off again. I'm wondering if we're going to see a Palantir case again, where we have this huge gap up on the earnings, and then it drops fairly rapidly back towards where it was, and you can almost draw a line straight through and cut off this sudden spike. Because looking at the chart, that does look a definite possibility.
Sure. And we've also seen some equities underperform, actually. For once, it's Nvidia and Microsoft.
Yeah, I mean, they're two of the key indicators, I think, as well for the tech boom and the AI interest. But, they've been driving a lot of the growth recently. And I think to some extent, it's normal to see a bit of a rotation towards a bit more of taking profit from those big gains, diversify your holdings. And also this morning, it's just come out that China has accused Nvidia of violating its anti-monopoly law. So that's dropped early on in early trading today. So Nvidia, if it loses the China market, then that could be a massive loss in terms of their market share.
Yeah, definitely. I mean, we saw, Trump block H100 chip sales into China. That will have that did impact their earnings.
Yep.
And it's a massively growth market for AI in general. So yeah, especially if China starts to develop their own cheaper chips, they're just as good. We'll see.
Yeah.
And that brings us on to the central bank OIS pricing for the next 12 months. So from the Fed, we have 127 basis points. That's up about 7 bips from last week. And I think a lot of that is becoming a bit more front loaded. From the ECB, only 11 basis points of cuts there.
Well, they held at the last meeting, but
Yeah.
you know, we've said before they probably do need to cut once more to at least
that's
once
what
more
the
to try
data
and
suggests.
stimulate some kind of revival in this kind of
Yeah.
lagging economy.
Yeah. And we've got the Bank of England at 38 bips of cuts. I mean, that's pretty steady. The RBNZ at 42. The RBA at 48. Canada at 49 bips of cuts, and the Bank of Japan at 43 bips of hikes. So we've seen some reasonable moves in OIS pricing, but everything's staying pretty steady there, really, for the most part. On Monday, we have received China retail sales, unemployment, fixed asset investment. On Tuesday, we'll get UK unemployment, Eurozone industrial production and consumer sentiment, US industrial production and US retail sales.
And then by Wednesday, we're going to get the US FOMC meeting, which we're expecting a 25 bip cut, and it's worth looking at the rhetoric we get there as well. UK and Eurozone inflation, plus the usual weekly US mortgage applications. And then on Thursday, we get Australian employment data, the Bank of England rate decision, and US jobless claims.
And on Friday, we have Japanese inflation data, which is obviously a key concerning bit lately. City Bank of Japan, they want to cut rate, they want to increase rates, so we'll see if they will keep going if inflation remains steady. And UK retail sales.
So looking ahead at the week, I mean, for me, the key focus is going to be FOMC. What's Powell's rhetoric? Does he maintain a more dovish tone, or does he flip back a little bit hawkish? What about you guys? What are you guys looking out for?
I think it's a tariff week again, really.
Yeah.
It's the threat of tariffs on India from what Trump wants to be NATO members and forcing NATO members and Europe to stop buying any kind of Russian energy products.
Yeah.
And how that develops will be key, I think.
Yeah. Spiros?
Yeah, I think definitely it's the FOMC and some key data that are coming from the US as well. Especially the industrial production and retail sales will be interesting to watch if we have any changes.
Yeah,
compared to
and
previous months.
consumer sentiment as well.
Yeah.
I think that'll be an interesting.
Because Michigan's consumer sentiment was pretty poor last week as well.
Yeah.
So we'll see if that's a broader trend.
Exactly. But that's all for us from today. Make sure to tune in next week. Stay up to date with our daily updates on LinkedIn from Onyx Institute, where we'll post a daily macro rundown each morning. Thank you for watching, and see you again.
Thank you.